Thank you for joining us on Minds of Commercial Real Estate. Today we have Gino Barbaro with Jake and Gino.
You got what I want, got what I want. You give me just one look and you know I'm good to go. You know I'm good to go.
Gino, thank you for being on the show.
Thank you for having me, brother. How we doing?
Everything's well, man. How about yourself?
I'm doing good. We get in a little rant before I hit the record button, so hopefully we can continue along the rant and the energy that we had. I really enjoyed the conversation.
Absolutely. Give a little bit of background about yourself and how you started in the real estate industry.
I am what you call a recovering pizza guy. I used to own a restaurant for years and years and years in New York. Yes, Gino Barbaro, pizza guy. And yes, my dad's name was Vito. So the stereotypes here they're just blowing up right now. I love the business. I have to be honest. I loved it until I didn't love it. That's just the reality. I was a one-stop shop. I was the prototypical mom and pop. I was in the business with the family and I loved it until '07 came. My dad passed away and I had to ask myself, am I living his dream or am I living my dream? And I realized I was sort of living his dream, although I loved it, but I didn't see any path forward for my family. I had 4 kids at the time. I have 6 children now. I'm like, and I'm living in New York, another, high tax state, a lot of, it was really expensive to live there. And I'm like, I can't keep doing this. I can't keep working harder and making less. I see the future. For some reason, I just saw that having one location in New York at the time was not a good idea. So I decided to get into real estate and I started doing some deals, did some really bad deals. I met my business partner, Jake, in 2009. He was the pharmaceutical rep coming to our restaurant, taking out food orders and bringing into the doctor's offices to sell vaccines. So hence, I was the pizza guy. He was the drug rep. We got together. And I guess the rest is history. It took us 18 months to find our first deal. And then after that, we just continued to buy assets. I stayed in the restaurant business another 5 years after I met Jake. And then I left in 2016 and went into the real estate business full time.
Very nice. Very nice. So what sector did you start in when you guys got into the real estate industry?
It's funny, Cam. For me, I already had the job. I was already going to work at the restaurant every day, and I felt that as if that was the job. I had dabbled in a couple mobile home parks, bad job I did. I had dabbled in some strip malls, didn't like that. But what I did like was I liked multifamily. I liked the duplexes and the triplexes. I liked the idea that people needed a basic human need. They needed some place to live. And I felt comfortable with that because I was also in the customer service business. I was, a restaurant owner. I like dealing with customers. So hence I like the resident side of multifamily. So I'm like, I don't want to fix and flip. I don't want to buy a single family home because I can only buy 1 or 2 a year. And that feels like a job also. So I said, Jake, let's just start multifamily. Let's start buying assets that, you can buy 10 units here and 12 units there. Since you're in Knoxville, Jake, you can drive around, you can manage these things, and we can start buying 1 or 2 deals a year, and we'll see how that goes.
What year did you start buying multifamily?
We started in 2011, and here's a lesson for everybody. When everyone says, well, that was the right time to get into it, let's just take a little time machine back into 2009, 2010, 2011. The world was on fire. And everyone's always saying, well, now the world is crazy and it's chaotic. Well, let's go back then. Like you could get a dart and throw a dart on a wall, and there were deals everywhere. Like you could find deals everywhere. They were literally trading for 25% of replacement value. But yet they weren't getting done because rents were horrible. GDP was 1%. Nobody was lending on these deals. And everyone was afraid. There was so much fear in the market that we just got in. We didn't know any better. But it did take us 18 months to find the first deal. We stuck with it. And for us, it was fortunate that we didn't know any better. We didn't know that was the bad time to get into real estate. There's never an opportune or a great time to get in. Because when you get in, you either have deals like we did back then, or you have capital. It's very hard to have both. And when both of them align, it's magical, but it doesn't last very long because then all of a sudden the capital starts to shrink, the deals go up, or the deals shrink and the capital starts to go up. So it's either one or the other. So when we started back in 2011, it was very challenging to say the least.
And then after your first deal, where did you acquire your second deal?
We acquired our very first deal in February of 2013. It was a 25-unit mom and pop. It was a little 6-unit efficiency motel that had another 18 or 19 units on. It was a total of 25 units. It was weekly renters. So when I say to you it had a little hair on it, that's That's really an understatement. It was what we call our little crack den. But hey, it got us in the game. That deal, we still own that deal today. It's probably worth $2.5 million now. We paid $600,000. Over time, we've been able to refinance it. We've been able to cash flow every month for the last 13 years. And what we loved about it was it got us in the game, and there was a lot of value that we could add to that. But after that first deal, it took us 3 months to find our second deal, our 36 unit deal. And we still own that deal as well. And that deal, we bought it for a great price point, same kind of problems, same kind of issues. It was a mom and pop owner, had no systems, had no processes, and was just trying to keep, all the renters in there, not trying to change anything. And we saw the value that we could add. Ironically enough, on that second deal, when we bought it, in-place income was $10,190. Never forget it. 6 months later, the income on that asset was almost $18,000. It was incredible what we did. And we honestly didn't really know what we were doing. We were just following what our mentors were teaching us, but we saw the intrinsic value in that and the ability to buy these assets that were totally mismanaged and be able to go in there and just raise rents and take care of the residents in the process.
How many units do you own today?
We have transacted on over 2,500 units. In the portfolio right now, we currently have a little over 1,900. We've done syndications. I told you before we hit the record button, we don't own any syndications currently, but we viewed syndications in our journey around 2018. Ramiro, that's when we started running out of money. We had no more capital. We did some seller financing. We did a bunch of refi and rolls, refinancing millions of dollars of capital, putting them back into the deals. But as we were scaling, we hit a wall, and we said, how do we get over that wall? And we decided, let's start syndicating deals. We syndicated 3 deals, a little over 400 units. And in that process, we found that investors are not our cup of tea. We'd rather buy deals with our own capital. Those 3 assets, within the next 2 or 3 years after that, we started exiting the syndications. We exited the last syndication in mid-2023. Since then, we've just been acquiring assets with our own capital. I mean, it was a great learning point. Syndication is an amazing tool. It's a great way to start and create a real estate business. Just for us, we'd already acquired enough units and we already knew what our goal was. It wasn't to acquire as many units as possible. What we wanted to focus on with our portfolio right now is our profitability. It's our profit per every single unit. And syndication doesn't allow for that metric to really explode because you're using other people's capital. Hey, you're using OPM, you're getting units under management, but at the same time, we want each one of those units to be as profitable as possible for our pockets, not only for our investors' pockets, if that makes sense.
At what moment during your this career was it that you were able to double, triple, or quadruple your units under management?
That is a great question. Remember the pizza guy? The pizza guy started in 1994, May 17th, 1994. That's when I bought my restaurant. I exited in 2016. I only had 1 restaurant in all of those years. With Jake and myself, it did take us 18 months to find the first deal. But within 5 years, we had a little over 700 units. It was incredible what happened. We were fortunate because in August of 2015, we closed on a 281 unit portfolio that was seller financed, 80% from the bank and 20% from the seller. I mean, incredible deal. And people say, you can't do that. We walked away from the closing table with $110,000. The title company was like, I've never seen this before. And I may never see it again, but it happened. And the moral to the story, and I think what you're trying to get at is, Gino, how did you do that? And I look back, the only logical explanation that I can give you is that Jake and I finally saw real estate as a business. With the pizza guy, I had no core values. I had no mission statement. I had no vision. I had no rhythms in my business. I was truly running it as a mom and pop. And when Jake and I started acquiring assets, all of a sudden you have a couple hundred units. We were what we call the IMA guys. I'm going to do this. I'm going to do that. And IMA gets burned out really quick. And we were getting burned out. But instead of saying, hey, you know what, we're going to double down and be twice as dumb, we pulled back and we had a podcast and we started interviewing all of these people that built these amazing businesses, whether it was Michael Gerber or Carmine Gallo right now was on the who had a podcast with, or we interviewed Robert Kiyosaki or Ken McElroy, these big names in real estate. And they all kept coming back to scaling and systems and processes. And I'm like, wow, I wish I had some systems and some processes in the restaurant. at the very least, it would have taken me out of the day to day, and I would have enjoyed the restaurant a little bit more. But I didn't even have that luxury. So that's what separated my life before Jake with that business, and then life after Jake, being in the real estate space, understanding that scalability comes through the systems and the processes and the hiring. And that's what I loved about multifamily. Having 100 units, all of a sudden I can hire property management. I can get maintenance people to work with me. I don't have to do it all. Jake doesn't have to sit on a tractor going out and cutting property, cutting lawns and collecting rents. We can hire people to help us do that.
So now that you have so many units, do you have a vertical integration for all these subs?
We do, and we're fortunate from the very beginning. There's no right or wrong answer for this. I want people to be clear. When we zoom out, when we started, we said we're going to start managing our assets ourselves, right? That's what we didn't know any better. We wanted to learn. You zoom back in, we still continue to do it. What a lot of people do is they will get third-party property management in the beginning to start. And that's great, understanding, but you have to understand how to manage the property management companies. You have to bring a level of asset management to it. But at a certain unit count, a lot of these operators say to themselves, hey, you know what? I think it's better if I bring property management in-house and I start managing the processes themselves and become what you call vertically integrated. And it's a cool term, but at the same time, there's pros and cons to it. When you're vertically integrated, you can't go out and buy thousands of units a year because all of a sudden you have team members, you have to hire, you cannot outgrow your infrastructure. That's what leads to the demise of a lot of operators and a lot of investors. They outgrow their infrastructure, they add on too much to their plate, and all of a sudden they don't have enough employees, or their systems break. When you have a company that's doing $1 million a year, there's certain systems in place for that. When you're doing $10 million a year, there's newer systems with that. It's the same thing with real estate. When you have 200 units, you don't have a COO. You don't have a regional. You don't have head of maintenance. But as you start growing, you start adding these positions on, and that's how you start scaling. So for us, the vertical integration made total sense. We learned the business, and it fit our model because we wanted to really extract as much value from every single unit that we had. And we thought, hey, if we can control the process and build a vertically integrated company, we don't have to own 7, 8, 10,000 units. 500 units is more than enough with this type of model. And then you can become selective. You don't have to make mistakes. You don't have to go out and do a deal just to do a deal because your other deals are performing really well. And that's what I see people doing. They're forcing deals because they have to collect fees. They have to create other types of income because they're not managing their properties. Properties are not being profitable because they're not controlling the processes with those properties.
All right. Thank you for all your expertise. That's a lot of inside information. Really appreciate that. And now let's go into a little bit of the financing. So like when you got your first deal, it took you 18 months to find. Did you go to a local bank to get a finance, or how did you put it together?
Well, for us, the reason why it took us 18 months is because we were a little dense. We didn't understand the role of the real estate broker in commercial real estate. Jake was a salesperson, and he thought that they had to sell him, when in reality, as an investor, I'm begging to meet more Cameos in the world. I'm begging to meet more brokers because I want them to like me. I want them to bring me deals. And when we understood that, and that script was flipped, and we met Rick, the broker, on our first deal, he also introduced us to the community bank that had the debt on the deal that we bought. So we used the community bank on our very first deal, and we were able to actually get 10% owner financing on the deal as well, because the sellers were like, I don't need all this money. What am I going to do with 120 grand? I'll take $60,000 as a seller finance note. It's great. They're getting mailbox money. They were getting $350 a month. We literally paid that loan off last month. We had that loan for 13 years. It's great. So for us, the financing came through Community Bank, and we actually refinanced that deal back out in 2016 to our current community bank. So for us, we love going to community banks. And now in this part of the market cycle, we like credit unions. Credit unions are great. They're not banks. So make sure you read the fine print, but their closing costs are very inexpensive. They're easy to work with. They give some great terms on deals. So using community or credit unions on the front end, which is what we call almost like bridge financing, but their terms are a lot longer than typical bridge, and they allow us to reposition the property, fix the property up, so ultimately we can take that property out and refinance it to either a Fannie or a Freddie product.
Yeah, usually with the credit unions, right, there's no prepayment penalties.
No, they're wonderful. Listen, their origination, their fees are a joke. They're like $10,000 for their fees. It's just great. They're easy to work with. Some of them give interest only. With the last one we had with was giving interest only for 2 years. Some of them are actually going out to 30-year amortizations. It's phenomenal. And those prepayments are great because after 2 years, you're ready to go. You could just pick up and move. But I'm telling you, they're great to work with on the front end. And I think they've become prevalent over the last 3 to 4 years. There was a void when rates went up. Community banks became too expensive because that Fed funds rate just shot everything up, and community banks, they couldn't compete. All of a sudden, the credit unions saw a void. They filled that void. And what better than to get into an asset class when you give like 65 or 70% LTV, like multifamily, when you're underwriting it conservatively, that's a nice asset that banks and credit unions want to hold, because if something does happen, they can just take that asset over and throw it on the open market, and they can, liquidate it and get their money back real quick.
And are majority of your finances recourse or non-recourse?
Great question. Typically, most of them start recourse on the front end, and from there, we take it out to Fannie or Freddie, non-recourse on the back end. And that's where we are right now. We're looking at a lot of our portfolio that we have the recourse debt. The last 3 or 4 deals we've done has been on recourse through these credit unions. We're just working through the cycle right now. As rates start to drop, we're going to start pushing them out to non-recourse.
Before we started recording, you mentioned you don't develop, you only buy the assets that are in queue. Do you ever think about going into development in the future?
That is a challenging question for me for a couple of reasons. I've got 6 children. I see how much work and love it takes to raise a child. And the development process is the same thing. There's a lot of risk. And I want to, tip my hat off to every freaking developer out there, because you put a lot of blood, a lot of sweat, a lot of tears, a lot of risk. You're trying to envision the future 3 years from now, what rents are going to be. You're underwriting today. You're looking at where the interest rate cycle is going to be 3 years from now. You're looking for what the appetite is going to be 3 years from now. Are 2 beds going to be in favor 3 years from now? You're looking, is that part of the market cycle going to still be viable 3 years from now? There is so much risk, and they are so underappreciated, because all I hear is we need more housing. We need more housing. Well, unleash the hounds. Because you guys and the government and all of these different municipalities are making building so difficult. And I can say this because Jake and I have a 70-acre piece of property in Knoxville. It's been 3 years we've been going through this process. It's a little over 200 units. We've got it under contract to sell. It's taken so long. It's taken like the soul out of me. I'm like, I can't imagine having to go through that. And now spending the next 2 to 3 years to develop. And we were thinking of developing it as a build-to-rent community. It's just way massively larger than our scale. I would have liked it if it was a 5 or 10 unit property, would have been able to sink my teeth into it. If I make some mistakes, not a big deal. But for any developer out there, any builder, or anybody who's hating on real estate, man, that is one of the most challenging, aspects, I think, niches in the business. It's very rewarding and it's very lucrative. That's all people see is the finished product. But I will promise you, I will guarantee you, it's such a hard job and a hard business to make money, because there's so many unknown variables and so many risks that so many people aren't willing to take. And the ones that are willing to take should be rewarded for the risk that they take.
What is the vision for your company? Where do you see it going, and where do you want it to be in the next 10 years and 20 years?
I love that question, because everyone who is in real estate, who is investing in real estate, whether you're investing in single family homes, whether you're investing in self-storage, mobile home parks, that should be the question. Like, what are you doing and what are you trying to serve? See, the problem that most of us encounter when we get into business is that we open a business to serve ourselves or to serve our family, instead of opening a business or starting a business to provide for the community or to provide for the market, or to provide for customers. For us, we become really customer centric. Jake always jokes around that he wants to become the Chick-fil-A of the apartment space, because the B and C space, let's be honest, is very challenging. Property management is a really hard job, probably almost as hard as developing, if not harder, because you are dealing with residents on a daily basis. And, our vernacular that we like to use, they're not tenants, they're residents. They're not units, they're apartment homes. So we really want to try to continue to deliver on our customer service. How do we do that? By working on work orders. Our maintenance work orders were something like 80% open rate. We wanted to get it to 97%, and that's where we are with our market right now. We're at 97% closed maintenance work orders. It's very important for us. We're working on our retention right now. That's the second tier. So for us in the next 10 years, if we can deliver superior customer service, and it's very challenging, but that's what the goal is. We want to retain these residents. We want to create that, that safe, affordable, comfortable place to live, because we know we're creating memories for people. When people turn that key and they walk into that home, we want to make sure that when they text us for a work order, we're there. When the renewal comes in, that they don't have to think twice about it. They're like, yep, we like this company, we want to sign. That's what I think everyone in the apartment space should be focused on. Not just their internal rate of return, not just a spreadsheet, but if you can focus on creating value, making that property better for the residents, making it a better resident experience, it'll lift all tides, it'll make all of us better, and we can deliver better customer service. And at the end of the day, when you do that, your NOI does go up because you are retaining residents. You are taking care of CapEx issues that don't become big CapEx tsunami problems because they're being taken care of today. So for us, 10 years down the road, we hope that we can achieve even a sliver of what Chick-fil-A has been allowed to do in the restaurant space.
Great. If you have one piece of advice for somebody who wants to go into the multifamily space today, what would you say?
If I had just one piece of advice,
Or a couple of advice, not just one.
No, I love that because I'm going to make it simple. And this is going to sound a little self-serving if you're in the education space. But for me, it really comes down to the first thing is just to get clarity. Not motivation, because you don't lack motivation, you lack clarity. Why are you getting into the multifamily space or the real estate space? You have to explain that to yourself because you need to be bought in. I knew how powerful real estate was. My mom owned the restaurant, but she also owned 3 apartments upstairs. And when it was snowing during the week and I wasn't getting paid, guess who was getting paid? My mom. She's getting paid even when she was sleeping at night. I had to go and work. I had to create earned income. My whole goal was to create wealth and to create portfolio and passive income. That's what multifamily allows you to do. And once you understand and you can paint that picture clearly to yourself and you're really dived into that picture, that feeling, that emotion, that I want that, then the next step is to really learn the business. And it is a business and you can learn it. And you need to use AI as a great tool, but you need to invest in your education. You need to become radically accountable and you need to be able to execute relentlessly. And the only way you do that, I'm sorry, is by joining education groups, masterminds, and by investing in your education. Because we can all sit in front of our computer with our underwear on and say, yeah, we're going to look at deals. But those of us that succeed not only invest in the education, but actually take steps. It's not only education, it's implementation. And AI can't help you with the implementation. Groups, people holding you accountable, putting it out there, making sure you show up every day. That's what's going to make you successful in any endeavor. And multifamily is no different.
Thank you. Thank you for that. And if there's one piece of advice you'd like to viewers to know about you, your company, or how they can get a hold of you.
Oh, just go to jakeandgino.com. We've got podcasts on there. We've got blogs on there. If you want to learn more about real estate, if you want to download our book, I just wrote a book called Happy Money, Happy Family, Happy Legacy. Just go to jakeandgino.com, click the button, and download the book because for me, it's really about multifamily, but multifamily really is a business. And if you're creating a legacy, you're creating a business, you're going to be leaving that legacy to your children. Let's prepare our children, on how to actually accept that legacy and become financial stewards themselves.
Thank you, Gino. Thank you for all the amazing information and for coming on the show.
Thank you, brother.
Thank you for watching. If you enjoyed this episode, please give us a thumbs up, subscribe, share any questions or comments in the comments below, and follow us on social media. I look forward to seeing you next time.